Imagine waking up to a nightmare. Your phone buzzes and the headlines jump out at you, each word a searing indictment of your hopes and dreams. Stock market meltdown. The robust portfolio you painstakingly built is now a smoldering ruin, its value halved overnight. This isn't just clickbait. It's a chilling warning from Jeremy Grantham, a legendary investor with a track record for predicting market crashes. Grantham believes the US stock market is a ticking time bomb, shockingly overpriced and primed for a catastrophic collapse. Are we standing on the edge of a financial abyss, or is Grantham merely another voice in the chorus of doomsayers? Stay with us as we unpack his dire predictions, examine the signs of an impending market bubble, and arm you with the strategies to protect your investments. Because in a world where financial stability can vanish in a heartbeat, understanding the risks is more crucial than ever. If you find this analysis insightful, please like and share this video to help others stay informed and prepared for potential market changes. For decades, Jeremy Grantham has been a respected voice in the financial world, known for his prescient calls and bold investment strategies. He co-founded GMO, a Boston-based asset management firm, and has a long history of challenging conventional wisdom. Now Grantham is raising a red flag, his voice a stark warning against the current state of the US stock market. In recent talks, Grantham has printed a picture of a market teetering on the brink of a collapse. He argues that the US market is in the midst of a dangerous bubble inflated far beyond its true value. He describes valuations as shockingly overpriced, exceeding historical norms and fueled by a combination of low interest rates, speculative behavior, and a sense of euphoria that can only end badly. Grantham, a seasoned investor with decades of experience navigating market cycles, is no stranger to booms and busts. His latest warnings are grounded in a historical understanding of super bubbles, periods of extreme market exuberance fueled by irrational investor behavior. These bubbles share common traits: a long bull market, rampant speculation, and a rapid acceleration towards a dramatic burst. Here is where it gets unsettling. The current bull market has stretched to a record-breaking 11 years. Since the onset of the COVID-19 pandemic, the Nasdaq has more than doubled, growing at over 3 times the normal rate. Grantham argues that this kind of rapid acceleration is a hallmark of a super bubble about to pop. Furthermore, speculative stocks, which typically outperform during bubble's peak, have already begun to decline. As of early last year, 40% of Nasdaq stocks were down over 50%, even as the S&P 500 reached its all-time highs. This pattern is eerily similar to those seen before the market crashes of 1929, 1972, and 2000. But how do we know if it's a bubble? According to Grantham, there are several telltale signs. One key indicator is the presence of crazy behavior, where investors chase after overhyped assets with little regard for fundamentals. This phenomenon was eerily reminiscent of the dot-com craze of the late 90s, with speculative vehicles like SPACs taking center stage before fizzing out spectacularly. Another crucial indicator is the performance of speculative assets within the market. Grantham points out that while the S&P 500 has continued to climb, assets often considered risky bets started losing steam, a classic bubble indicator. It's like the party is still going on in the main hall, but the whispers of unease have begun to ripple through the backrooms. The potential consequences of Grantham's prediction are nothing short of chilling. He predicts a significant decline for S&P 500, a drop of at least 50%, mirroring the devastating tech bubble crash of 2000. Imagine your retirement savings, your college funds, your carefully cultivated nest egg, all losing half their value in a single brutal blow. But what's driving this potential crash? Several factors are converging to create a perfect storm. High inflation. Stock markets typically despise inflation as it erodes the future value of earnings. Companies become less profitable, making their stocks less attractive. Rising interest rates. The Federal Reserve, in its attempt to combat inflation, may hike interest rates. This makes borrowing more expensive, reducing corporate investment and potentially leading to a decline in stock prices. Stagnant economic growth. Limited economic growth means companies won't be able to generate significant future earnings, impacting stock prices. A stagnant economy often coincides with a decline in consumer spending, further hindering corporate profits. While the US market faces significant risks, Grantham suggests that other markets may offer some refuge. Countries like Australia, the UK, and Japan are less overpriced and may not experience the same level of decline. Emerging markets, despite their inherent risks, present compelling opportunities due to their relative undervaluation and higher growth potential. Grantham highlights that emerging markets are currently very cheap, with valuations comparable to historical lows. These markets offer higher top-line revenue growth compared to developed markets, which have seen declining productivity and workforce growth. As a result, emerging markets may provide better long-term returns for investors willing to navigate the associated risks. Given the potential for a market crash, how can investors protect their hard-earned cash and even benefit from the downturn? Grantham offers several key strategies. Dodge the overpriced, focus on value investing, and steer clear of markets demonstrably inflated. Prioritize cheapness for what you get and hunt for cheaper countries and stocks within those countries. Embrace global diversification. Consider increasing your exposure to non-US stocks, particularly in markets that aren't as overvalued. Emerging markets, with their attractive combination of lower valuations and higher growth potential, offer compelling opportunities. Hold cash reserves. Maintain a cash buffer to capitalize on buying opportunities that may arise during the market downturn. This will allow you to scoop up quality assets at discounted prices when the market throws a sale. Focus on quality stocks. If US stocks remain your focus, prioritize high-quality companies with robust financials. These companies are better positioned to weather the storm and rebound faster after a crash. Look for companies with a history of profitability, strong management teams, and a sustainable competitive advantage. Stay informed and vigilant. Keep abreast of market developments and be prepared to adapt your strategy as needed. The market is a dynamic beast, and staying informed allows you to make sound investment decisions. Subscribe to our YouTube channel for insightful financial content and updates to help you navigate the ever-changing market landscape. Don't fear the future, prepare for it. Jeremy Grantham's prediction of a market crash may seem like a doomsday prophecy, but it serves as a valuable wake-up call. By understanding the signs of a bubble, the potential causes of a crash, and the strategies to navigate such a storm, you can control your financial well-being. Remember, even if Grantham is wrong, the financial world is never static. Market downturns are inevitable, and being prepared can make a world of difference. By diversifying your portfolio, focusing on long-term value, and staying informed, you can weather any storm and emerge stronger on the other side. So take the deep breath, acknowledge the possibility of a downturn, and take proactive steps to safeguard your financial future. After all, knowledge is power, and in the world of finance, it's the power to weather the storm. Like, subscribe, and ping the notification bell for updates. Stay safe.